This is a introductory session on Treasury bonds. So basically, Treasury bonds are issued by various governments to finance their fundings, and Treasury bonds are normally, the length is more than 1 year. So there are some attributes of a treasury bond which is used to characterize a specific bond, such as the maturity of the bond, the coupon on that particular bond, and the face value of that bond. US treasury bonds specifically pay coupons every 6 months, in other words, semi-annually. And another thing to remember when you look at any bond, we have something called the accrued interest based on when are you calculating the cash price of the bond. Now, so for example, in this bond, assume that we are at 8th of June 2020. So assume that you're here, 8th of June 2020, and the last coupon on this particular bond was paid on the 31st of December 2019. And therefore, in 6 months' time, there will be another coupon. Let's assume this is a treasury bond, US treasury bond. So the next coupon is in 6 months' time, which is 30th of June 2020. And let's assume that this particular bond matures on 31st of December 2021. So that's here. So every 6 months, you'll have coupon payments. And then finally, the bond matures. But at this point, you can see some interest has been accrued because the last coupon was paid on 31st of December, and now we are on 8th of June, because we know the next coupon payment will be on the 30th of June. So that means there's 160 days that has passed from the last coupon date, and for these 160 days some interest or some coupon has been accrued, and we can calculate that coupon. Remember, 2% is the coupon for a whole year, and we can use this fraction to calculate the coupon for that has been accrued from the last coupon date to the current date. And the formula is quite simple. So remember, the coupon, we said 2% is for the whole year. So US treasury bond pays coupons every 6 months. So this is for the whole year. So here in this formula here, we are just assuming the notional is $100 based on this. Remember, before when we spoke about the definition, we said it's $1,000. So don't get confused here. For the calculations, we are just using these details here. And here we are assuming the face value has $100. So if we say the face value is $100 and the annual coupon is 2%, so every 6 months, so that's what we are multiplying by 0.5, because this 2% is for a whole year. So every 6 months, so that's 0.5, half a year, we'll pay coupon of $1. So there'll be a coupon of $1 being paid here, a coupon of $1 being paid here, coupon of $1 being paid here, and $1 here for every $100. So the last coupon was $1 was paid 31st of December 2019, and as of 8th of June 2020, a part of that coupon has been now accrued. So in order to calculate the accrued interest, you start with your 6-month coupon, the semi-annual coupon, which is $1. Remember, this $1 is for this whole 182 days. Because once you pay the last $1 here, and then the next coupon date is here. So this $1 is for this whole 182 days. But you're here, and if you want to calculate the accrued interest, how much interest has been accrued since the last coupon date. So you have passed 160 days. So accrued interest is 160 divided by 182, because 182 is the days between two coupon dates, between these two coupon dates. Because remember, this $1 is for these 182 days. So we calculate the fraction of this $1 that has accrued up to now, which is 87 cents. Now, the reason accrued interest is important, let's assume that this bond has to be sold somewhere here. You're planning to sell this bond. If you're planning to sell the bond, you need to factor this accrued interest in the cash price that will be received, or the actual cash that will be received from the buyer, because this interest has been accrued. And when the buyer buys this bond on the 8th of June, in few days the buyer is going to receive $1. But as you know, that whole $1 does not belong to the buyer, because you have been holding this bond for 160 days. So that's the reason you need to include this in the cash price of the bond, so that you can get this money from the buyer if you're planning to sell this bond on the 8th of June. And that's one of the reasons you need to calculate the accrued interest. Another important concept is that, so we have two kinds of prices. One's called the cash price. So cash price of a bond equals the quoted price of the bond plus the accrued interest. Now, quoted price of the bond is actually the price that traders use when they quote a particular bond's price, and when they discuss bond prices, traders use the quoted price. In other words, if you see a bid offer price for a particular bond, you will normally see the quoted price in most of the screens. Now, if you want to calculate the cash price, you have to add the accrued interest. Now, in this case, let's assume the quoted price was $98. This same bond, let's assume that on a sort of 8th of June, this bond is quoted at $98. Now, if you want to sell this bond to someone, you do not sell it at $98. You need to calculate the cash price. Remember, we said for the cash price, we need to add the accrued interest, because some interest has been accruing from the last coupon date. So the accrued interest is 87 cents. We calculated it here, 87 cents. So you need to add the accrued interest to the quoted price to calculate the cash price. So this is the price. If you're selling this bond as at 8th of June, you will be receiving $98.87, not just $98. So it's important to know the cash price as well. So you can see the cash price, even if the quoted price doesn't change between two coupon dates, the cash price will change, because the accrued interest, you can see the accrued interest will slowly increase, come to $1, and then it will drop the next day again, and then keep increasing, and then again it will drop at each coupon date. So the difference between cash price and quoted price is the quoted price does not include accrued interest, and cash price includes accrued interest. You need to add the accrued interest to the quoted price in order to calculate the cash price. So the quoted price is also called as the clean price of a bond, and the cash price is called the dirty price of a bond. So dirty price equals clean price plus accrued interest. So traders normally use the quoted price of a bond. So if you have any questions, this is a basic introduction to treasury bonds and how treasury bonds work. And in the next couple of sections, we will be talking about the law of one price, how to calculate discount rates using treasury bonds. If you have any questions, drop us an email, or you can send a message as well. Thank you.